I think it's all but a foregone conclusion. They will raise rates in December, and I think they should do that because they're affirming the strength of the U.S. economy and only lifting their foot off the gas pedal. They're not hitting the brake yet. Their job here, we're in a marathon. We now got the second longest expansion of the post-World War II period, and their job is to pace us. They're the coach trying to pace us, and not when we're sprinting, as we are in this year. And I agree with Steve that 3% plus growth is not sustainable, and we might be pulling some growth forward. Still, they have to react to that. That's where they're at in reaction mode, and there's a growing consensus, I think, within the Fed that they might feel they're now behind the curve on inflation, in part because of what Steve mentioned, that tariffs are stagflationary. That's the hardest of all areas for the Fed to be.
Is it possible, Peter, though, that the Fed's missing the boat, that they don't fully understand how tough tariffs can be? We're hearing it from CEO after CEO after CEO. You think the Fed's paying enough attention to that?
Well, to that point, it's a growth drag, but on the other hand, it's this inflationary situation. As Diane said, it is stagflationary, creating a much more difficult situation for the Fed. So here we are in this 10th year of this expansion, and the Fed funds rate on a real basis is only 0. Historically, it was 200 to 300 basis points above the rate of inflation. So tariffs are going to slow things. Interest rates are going to slow certainly the housing and auto industry even further, but at the same time create this bid under the rate of inflation that a tight labor market potentially can only enhance.